What's up, everyone? Today, I want to talk about what I think is one of the biggest financial lies in the financial industry. And that is that you're actually saving money in taxes when you contribute to an IRA or 401k or any sort of qualified retirement account. Now, keep in mind, this is not tax advice. This is not financial advice. This is just showing you simple math. But what do you think the biggest reason people contribute to a 401k or qualified retirement plan is? If you talk to anybody, most of the time people say, well, I get to deduct the cost. I save money on taxes. There's really no tax savings. And I go into this in depth in my course. But right now, I want to give you a high level idea, and you can do the math on your own time. All right. So go to some sort of compounding interest calculator. You can find them online. They're free. And just pick a number. Let's say that you invested $10,000 and you did it for 25 years. Okay. You can pick the rate of return. Say it's an 8% rate of return. You'll come up with a number. Okay. Now, what's the alternative? So if I put $10,000 in, ideally I can deduct the $10,000 of money off my income in that year, but I'm going to have to pay the tax on the back end. I'm going to have to pay the tax when I take the money out. Okay. So let's say I'm in a 30% tax bracket. All right. So I put $10,000 in, and then I let that money grow, and there's no taxes due. Look at how much money I have in the account. It's a lie. What if I just paid the taxes up front? I said, okay, here's $10,000 I want to invest, but I want to pay the tax on the 10,000, 30%. So now I invest $7,000 instead of the 10. It's a smaller number. Let's say the $7,000 goes into the same stocks, mutual funds, whatever you want to do, the same investment, and it gets the same 8% rate of return over the same 25-year timeline. You're going to have a number at the end, and it's smaller than what would have been in the $10,000 account. So you have a $10,000 pre-tax account and you have a $7,000 post-tax account. And let's assume that $7,000 went into, I don't know, like a Roth or something that's tax-free or tax exempt. So there's no tax due on the back end. Well, when you talk to your advisor and when you look at the piece of paper, the $10,000 contribution at an 8% rate of return for 25 years, you're going to have more money in that account than you will in the $7,000 contribution account. That's just math. What's not being told, though? The taxes haven't been paid on the $10,000 pre-tax account. So let's assume everything stays the same. You're still in a 30% tax bracket. Not only have you given up use of that money for the last 25 years, it's locked into an account. Let's just assume, though, that your tax rate's the same. So you go to pull money out. Take that large account number and multiply it by 0.7, which means it's the after-tax value of what that account is. Now, I did this presentation to someone who actually works in a qualified retirement account business. Like her company manages accounts for employees. Okay. I had her do this math and she was blown away. She stopped the meeting and said, how did you do that? I said, you got to be kidding me. You've never done the math on how this works? There's no tax savings. It's a tax postponement. You lock the money up and you're allowing the government to dictate how much they're going to take. Assuming everything is the same, when you take money out in the end, there is absolutely no difference. The difference is all the ancillary taxes that get tagged on when you start to show a lot of income, like Social Security tax and Medicare tax, but that's a whole nother conversation. The account values, pre-tax, post-tax, they're exactly the same, assuming tax rates don't change. Now, here's the part that you have to ask yourself. Where do you think tax rates are going? There's $27 trillion in debt right now. And the current administration is talking constantly about how to tax the wealthy their fair share. So if you get what you want out of life and you earn a lot of money, you make a lot of income, and you save a bunch of money for retirement, do you want to take a step back in lifestyle when you retire? I have never met someone say, look, when I retire, make sure that I live on less cash flow than I have today. That doesn't sound like fun. Now, most Americans will probably get benefit from a pre-taxed account because most Americans don't have a tax problem. They have an income problem. If you look at the averages of who pays what in taxes, most people that get a 401k and they get a match at their job, they're going to benefit. They're going to benefit from having a pre-taxed account. But if your goal and your intention is to have a lot of money and be successful in life, your pre-taxed account is going to cost you the same amount upfront in taxation. There is no tax savings if you are in the same exact tax bracket. And so the only way that a 401k is going to be able to help you is that if you plan on reducing your lifestyle throughout retirement, if you plan on living on less, and honestly, that's cool. If you want to do that, that's fine. The goal of this whole channel is to teach people the ramifications of the decisions that they're making, right? I want to teach you what's going to happen if you get what you want. And the people that I work with, if you're making over 100,000 a year, those people usually aren't ready to take a step down in lifestyle. Usually they want to have a better lifestyle. They want to be able to travel and see grandkids and see family and go on vacation. That's why you worked your whole life, to enjoy the fruits of your labor. So if you like this kind of information, smash that subscribe button down below and follow along.